Welcome to another episode of Fireside Chicago, where we host fireside chats with prominent leaders from Chicago's business community, live on Zoom with Q&A every Tuesday, Thursday at 11:30 a.m. Central Standard Time. I'm your host, Tim Shum. I'm also the founder and president of Lucas James Talent Partners. We have Nick Moran on the show today. We're going to get to Nick in just a second. Before we get to Nick, I just want to round out some of the guests that we have for April. Of course, we're speaking with Nick today. On Thursday, April 30th, we're going to be speaking with Jeff Ratchet. For those that don't know Jeff is the founder and CEO of Sales Assembly. Jeff's one of the most well-networked, connected individuals within the Chicago technology B2B SaaS scene. So I'm really interested to speak with Jeff on Thursday just to get his take on what he's seeing from his customer base with his network as it relates to COVID. So we're going to be talking everything sales, marketing, how to pivot within this environment for sure. So tune in if you're interested in technology, sales, marketing on Thursday for sure. We also have a very, very strong group in May. I'm going to get out the registration links for everyone for May. So if you haven't already, follow Fireside Chicago on LinkedIn. We're going to grab your email address. Feel free to unsubscribe, but we're going to be sending out the May guests here in a second. So if that interests you, we'd love to have you back. Moving along on the show today, we have Nick Moran. Nick is the founder and general partner at Newstack Ventures, a Chicago-based seed stage venture capital firm. Prior to Newstack, Nick spent time as both an investor and a business operator. He worked in mergers and acquisitions at Danaher, a science and technology-based conglomerate. In addition to the fund, Nick founded the first venture capital podcast called The Full Ratchet in May of 2014. He also leads the largest angel group based in the Midwest, including over 1,000 angels and family office investors. Ladies and gentlemen, Nick Moran. Nick, welcome to the show.
Tim, thanks for having me.
Absolutely. Absolutely. So we've known each other for, I think, 3 years. I'd love to get into the story about how we met. Before we do that, could you just give a quick intro about yourself, how you got into venture capital, maybe a little bit about your podcast for the viewers?
Sure. Yeah. So as you said in the intro, I used to do M&A for a large conglomerate, very aggressive acquirer. I did that for probably about 4 years, and then I transitioned into product management, sort of an entrepreneur role. So within the confines of a large corporation, I was launching a new disruptive product. This product was in the water analytics space, and it took about 3 years. We had a big R&D team and about 3 years of effort to launch this thing, but it became a banner success for the organization. So I had the good fortune of having the ability to leave corporate America at a pretty young age, about 32. Was able to move back to Chicago with my wife and take a couple of years off and use some of the financial proceeds from that success to angel invest. So that was the beginning of my sort of entree into venture. And pretty quickly I realized that in order to get relationships, to build a network, to get what we call deal flow in the VC industry, you really need to provide value. You need to build a brand. You need to build an audience. And that was kind of the origin story for the podcast. And I can talk more about that if you want, but that was the reason we launched the show. And subsequently the angel group came together, and then the venture fund.
Talk a little bit about Newstack. When did you start it? What's your focus in terms of investment criteria? What are you looking at now? All that kind of stuff.
Yeah, Newstack started in 2015. We're a pre-seed venture fund located in Chicago. We invest nationwide, but we tend to avoid San Francisco and New York City. Those areas are pretty well covered by many of our peer institutions. But we invest very early. We like to be first check in. The first institutional round that a lot of people refer to as pre-seed now. We'll typically do a check in the 200K to 500K range. So we top out at about $500,000. And we also have an expertise in deep tech and hard tech. So there's not really many folks that want to lead deals in the middle of the country if there's hardware involved or deep tech involved. So we've really been able to differentiate ourselves as being kind of the only investor that wants to lead those deals and specialize in those. It's not all we do, but it's one of our unique specialties, and that goes back to my background. The product I mentioned before was a hard tech device with SaaS as well and the consumable. So we often end up partnering with young startups that are doing similar models.
When you say hard tech and deep tech, I think I have a strong idea. I listen to the podcast. We've known each other. I guess for some of the viewers that aren't familiar with your industry as much, or new stacks in particular, but what are some of those examples of maybe products that you're interested in?
Yeah, I mean, hard tech, you can just think of any hardware, right? Hardware that has technology with it. So, Elon Musk has kind of made the hard tech category pretty famous with both SpaceX and Tesla. Deep tech is related. Deep tech often has a hardware element, but it doesn't necessarily have to. The way we define deep tech at NewStack is that there's long-term defensibility associated with intellectual property. So most of the deep tech stuff we invest in have sort of a patent moat around it. And many of those products happen to, be hardware in nature. Not all of them, but the majority are either hardware in nature or heavy artificial intelligence, machine learning, natural language processing oriented.
Most of the venture capital folks, the angel investors that I know and I come across, most of the deal flow, the investments that they make, I've done some angel investing. The investing that I've done is very much, software based SaaS models. It's easier to maybe understand that space a little bit more. If you understand maybe the industry that the software is going into, you can make an investment decision kind of based off that. I feel like the hardware space might be a little bit trickier to kind of navigate. And you said maybe it's based on your experience at Danaher, your interest, the focus of NewStack, that you're focused in that area. What percentage of venture capital firms are focused on investments within the hard tech or deep tech space, would you say?
It's probably 5 to 7% of total VC firms. When I got to Chicago, there was nobody specializing in hardware or hard tech. So we had a laundry list of SaaS investors, enterprise software as a service, probably some of the things that you're more familiar with. And that's a great category. But, you've got all these investors investing in kind of one area, and then the very compelling hard tech founders here in town just couldn't get funding. And that's a category that I'm really comfortable with. The risk profile there, I'm just very comfortable with it. Yes, manufacturing, tooling, sourcing, inventory management, returns management, those are all challenges, but there's practiced blocking and those are not the most complicated things about success with a startup. Really building something that people want, getting the unit economics right, getting customer acquisition efficient, creating long-term value and retaining customers for extended periods of time. That's really the trickiest part about venture capital. It's not, tooling and product fulfillment. Those are areas that have been perfected, and there's a lot of tools and processes that can remove or at least lower the risk profile for those elements. So we don't let the hard tech nature of a product or a physical product get in the way of what we consider to be the most challenging part about venture capital, which is why we specialize there and we invest in it.
Absolutely. So talk a little bit about the podcast. It's called The Full Ratchet for folks that have never met Nick, listened to the podcast before, or maybe new to the venture capital space. When I met you, I started listening to the podcast. I find it very inquisitive. I found it very entertaining for someone that's maybe a neophyte to venture capital. I've learned a lot kind of through that. I learned a lot about how the financing elements of like just the tech scene in general, how that operates and how that trickles into how companies are funded, how they scale very quickly. Sure. You've got a lot of followers. Talk a little bit about maybe where you were at in your venture capital career when you started the podcast, why, and then the evolution of the podcast over time to what it is today.
Yeah, where I was at, so I was just an independent angel investor at the time. I was doing 25K, 50K checks in the early stage startups as an independent when I launched the show. Now, over time, after launching the show, a lot of the angels in Chicago reached out to me And so we began to mobilize as a group in Chicago. So the first iteration of New Stack was really just a small angel group of about 40 to 50 folks in Chicago. Then we migrated that group online, and we use a platform called AngelList to organize all our deals and to organize our group. So we moved that group online, and I began messaging to folks on the podcast, hey, if you'd like to see the deals we're doing, if you'd like to read our thesis on investment, you can join the group on AngelList, just search for New Stack Ventures. And that's when we started seeing, mass groups of people joining the group, a lot larger than we expected. So that group has gotten quite large. It's a lot of independent angel investors as well as family offices. So these are all accredited investors or qualified investors. We don't have to get into the definition of that, but high net worth or ultra high net worth individuals that want to invest in the asset class. So that was like generation one of New Stack, was really just this kind of distributed angel group. Some folks in Chicago, some folks all over the country. I think the majority of our investors are in California, then New York, and then Illinois. But we started doing deals on that platform. I would find a deal, I'd put my own money in, we'd make it available to other group members, and then they could bolt in around us, which enabled us to do much more substantial checks, right? Instead of me cutting a 25K check, we could do 250K, 300K, 400K. So that was kind of Gen 1. Of course, we did about 10 of those deals, and we're very lucky and fortunate with those first 10 to have a lot of success. So then the pressure kind of came from a lot of folks, Nick, when are you going to raise a fund? And eventually when I felt ready to be a fiduciary and manage other people's money and make decisions on their behalf, that's when we did a close on Fund 1. That was in 2018. So, before that, I was electing into my own investments and giving other people the ability to opt in if they wanted. But it took me a few years of doing this to really have the confidence that we had a system and we had a process and we had an approach for identifying founders that we thought were really compelling early stage. So anyway, that's kind of a bit of a mix of kind of the angel group, the podcast, and the fund, but I can go deeper on any of those if you'd like.
Oh, that's all good. That's all good. Yeah, appreciate you going into that. Yeah, there's each show essentially has a different venture capitalist on the show that serves maybe a different industry, different side of a different coast or whatever. So you're getting insights into how they invest, how they think about business, how they think about their sector. More recently, you've kind of moved into crisis coverage shows. So how the venture capital community is adapting to the COVID-19 situation. You've talked to a lot of folks, I'm sure probably on the show. You have your own thesis around how this is going to affect your portfolio and your investing decisions. How is this situation that we're in affecting the venture capital community? And how does that kind of trickle into founders that are looking for funding and then just the technology economy at large?
Yeah. Well, apologies for not answering your question directly about the show. Yeah, we started the show 6 years ago, and it's gone through a lot of iterations, but it's been a huge part of our network and our success for sure. As you mentioned, we did launch crisis coverage probably mid-March, early March timeframe. So we've been publishing a lot more frequently with a lot more guests to kind of assess how this pandemic affects the venture industry and startups. So to answer that question, I think the first thing that I've noticed is a lot of the tourist capital is going away. And when I say tourist capital, I mean non-institutional players, so non-venture capitalists. So in some cases, angel investors are kind of contracting, holding back for a bit. Family offices are holding back. A lot of the crossover funds, so hedge funds and big, financial players that have come into the venture market late stage. We think a lot of those are going away or going to contract faster. It's the VCs that have assets under management that are not going to go away. So folks like ourselves, we go out and we raise money from what are called limited partners. So those could be high net worth individuals, those could be other institutions. But when they invest in us, that capital is committed. So what that means is, we have a mandate to deploy that capital over usually 3 years, 3 to 5 years deployment schedule. So that mandate hasn't disappeared, right? We still have capital committed, and it's my job to deploy it wisely and carefully in the right startups. So I'll continue to do so, and other VCs will continue to do so. There are VCs that are slowing down significantly, right? So making a decision over Zoom is quite difficult for a lot. They can't do diligence. They can't get to know people in person. They can't have dinner. People are coming up with very creative ways to get to know each other over Zoom, doing fitness sessions together, or having dinner together, or playing board games over Zoom. It's kind of interesting to see these, but it's hard to make a commitment to partner with somebody for the next 6 to 10 years when you've only met them over Zoom. So that's causing a lot of people to slow down. A lot of people are slowing down because they just want to see how the next couple months shake out and what sectors are most impacted. And then others are reducing their check size. So we're doing that. We used to cut, right around about $500,000 in the 400 to 700K range, and we're now down in the 200 to 400K range. So because of the crisis, we're likely not going to be able to raise a fund as rapidly as expected, and we just kind of want to diversify our risk a bit. So we've lowered our check size, and we'll do more investments from the existing fund to kind of address what's happened.
With all of this, so you're basically saying, you use the term dry powder quite a bit on the show, and that essentially means that means you have additional capital that's committed that you have to spend at some point, right? You're talking about smaller check sizes on new investments. Are some VCs, including yourself, maybe looking at your existing portfolio to use some of that dry powder to help them through this, even though that wasn't the plan maybe 8 or 10 weeks ago?
It's possible. Some VCs might. It depends. So when you raise a venture fund, you typically set an initial check strategy, and then you set a reserve strategy, and you allocate dollars for each. So a certain amount of your fund is just for new deals, for new startups that you're partnering with, and then a certain percentage of your fund is for re-upping into existing companies. There's a couple different reserve types. There's offensive and defensive. So you can just re-up in investments that are increasing in value, that are doing a Series A or a Series B round with much bigger venture capitalists at much bigger valuations. You can also help extend your companies. So if your companies are going through a rough time and they're very low on cash, you can provide some more financing to help extend them and get them to the next major milestone so that they can go back out to external parties to raise money. So it really depends on the strategy. But I don't see a lot of venture capitalists taking initial check money and reappropriating that for reserves. I don't think that will happen in a significant way.
Interesting. Okay. Very cool. And I think for a lot of the audience, you don't have to be an expert within venture capital. But I got to imagine this would affect the tightening up of M&A activity for the eventual exits of some of these companies. You've been on the other side of the fence, making purchasing decisions for Danaher, right? So how do you see this affecting the exit side of the venture capital cycle for some of these companies?
My personal opinion is that in the near term, it's going to be really tough. A lot of folks at large corporations they're not as risk seeking as folks on the venture side. And, their careers are kind of made on not making bad decisions more so than making great decisions. The great decisions take a long time to play out, and the bad decisions usually you find out about pretty quick. So my expectation is that M&A activity from strategic acquirers will slow down. Now, that being said, I've had some folks on the podcast that think M&A is going to be much more viable and much more active near term than the IPO market, for instance. That's another exit path for startups. I tend to disagree with that. I don't see M&A being very aggressive and active in picking up startups on the cheap right now. Now, each corporation, of course, is different, right? There are corporations that are more aggressive about it and others that aren't. But generally speaking, I think that the exit market, strategics and IPOs, are going to be closed through the next couple quarters.
There's got to be some companies out there, you know, whether you're small business, middle market, Fortune 1000. I think some leaders are looking at this and saying, like, this is my time to double down, you know, be aggressive, get on the offense. That might not mean, you know, pick up a SaaS company at a 15x multiple, you know, right now.
Right.
But there's got to be some folks that are still doing that. Now, the valuations, the price point of some of these comes into play. And I got to imagine that's changed things dramatically on the front end of making an investment in terms of maybe the deals that you're doing. And then, of course, down the road, once M&A activity picks up again. How do you look at valuations in an environment like this, that there's so much uncertainty, and the playbook that we've used from 2012 to 2019 or the first part of 2020 almost needs to be thrown out of the, thrown out for the most part? How do you look at valuations in this market?
Yeah. It's a good question. I think there's probably 3 different types of startups right now, and the valuation impact is different for each. So startups that are negatively impacted by COVID, those are just not getting funded. And they're not going to get funded for the near term. If the effect of COVID is neutral on a startup, if it's hard to tell whether it's positive or negative, most of those deals are just slowing down, and investors are going to wait to see how metrics shake out, you know, through this period before they pull the trigger on those. And then if COVID is having a positive impact on your business, you will get offers now. But in my experience, I've been seeing about a 20 to 40% haircut on valuations. Even in my portfolio, I mean, really successful companies that are benefiting significantly from the crisis are getting reduced valuations. I've seen term sheets be pulled. I've seen more than 3 term sheets pulled from startups. So a term sheet is an offer for investment. And fortunately, you know, we've had good luck finding other investors for it, really high quality investors, but the valuations have taken a pretty significant hit. So anyway, that's what we're seeing now. Now, I had Tom Tungus on the program yesterday. He's a prominent SaaS investor at Redpoint. And he said for hot categories in SaaS right now, he has not seen a corresponding dip in valuations. He's seeing valuations hold for the moment in his data. So, you know, I'm seeing a hit for my Midwest portfolio. He's not seeing a hit yet, but largely speaking, I would assume that there will be a haircut on valuations for startups across the board.
So say I'm a founder in a technology company. I run a services business, a little bit different, but maybe I'm caught, unfortunately, on my funding cycle. You know, COVID hit right when I was raising, right when I was negotiating with my existing investors, new investors, what have you. Is that where the substantial decreases in valuation are happening? Because I got to imagine there's also founders that are like, I don't want to take a huge haircut here. I might have to run my business differently, extend my runway, do things with cost containment, things like that. Because that's got to be a tough pill to swallow for a founder, but also provides opportunity for, you know, folks that want to partner with those founders that are in a tough spot. How do you kind of navigate that? Because I got to imagine that's a tougher conversation than the previous 7-8 years.
Well, it's really tough. I mean, there's definitely a lot of founders that are in a super tight cash position that had active, engaged conversations going on with investors when all this broke. And now they're in a shitty position, honestly. You know, it's not an investor's job to bail those people out. We're running our own businesses, right? I have fiduciary. I am a fiduciary. I have limited partners that are, you know, relying on me to make good decisions and make those decisions at the appropriate fair market valuation right now. So there's scrutiny at all levels here, and we all have to kind of run our own business the best way we can. You know, even Newstack's budget has contracted amidst this crisis. You know, we have long-term sponsorship agreements on the podcast that subsidizes our team of, we have 7 folks right now. You know, some of those sponsorships have gone away or contracted. And so that changes our budget profile and our ability to maintain our staff. And, you know, we've got a rainy day fund, thankfully, but it's created challenges. So, you know, there's not a one size fits all set of recommendations here. I think every founder should be tightening up as much as they can on discretionary spend. They should be trying to lengthen out that runway as much as possible and hit meaningful milestones, show progress to investors so that they can raise at a fair, you know, at a fair market valuation. But it's tough. I mean, we have 2 founders that are in our existing portfolio that are in the middle of a fundraise right now. And it's been really challenging, and their cash position is short. So they've had to make some pretty deep cuts in a variety of areas, in some cases, leverage the PPP funding, and in other cases, grants. You know, go to the NSF, there's SBIR and STTR grants. It's not always the best path for startups, but in some cases, you know, anything that can help bridge this period and get to kind of into the middle of next year of 2021 is kind of a smart move, even if it's not the most strategic decision.
Well, I also think to my earlier point in our earlier discussion, there's got to be some founders that have to understand that, hey, let me link up with a partner, and like, yeah, the numbers might look a little bit different, but let's double down on what we have going on right now and take advantage and know that our competition is, you know, struggling through this. And that's probably part of the play, regardless of the valuation discussion, for sure.
Yeah, you made a good point before with the reserves, right? Like, existing founders, the first door to knock on is your existing investors. If you have existing investors, you can go to insiders and see if they'll extend you, see if they'll help provide more runway to get to that next major meaningful milestone. If you go to the external markets and you're in a tough situation, it's going to be a long slog.
No doubt. No doubt. Nick, do you have a time for a few questions? We got some questions from the attendees. Kevin Nickel, who I think we both know, I think I introduced you to Kevin, Western Suburbs guy. He asks, can you give a sense of how long you spend with someone before you decide you are likely to invest? Is it less time with smaller checks, given the COVID scenario?
You know, we're always trying to get more efficient about interacting with founders. We want to be respectful of their time, and we also, you know, need to manage our own time. So we have internal OKRs to get faster in our diligence process, to move quicker, and that's absent of COVID. Now, the situation with the virus is probably going to work against that, right? Because we're going to have more touch points over Zoom to get to the same level of comfort with the founders and make sure that the relationship is there. Without having the opportunity to meet in person, it might take more touch points. That's the working hypothesis, at least. But, you know, we try and be as fast as possible. I would say if we meet a startup and they're ready for funding, so they have hit the appropriate level of traction or milestones or progress for the stage they're raising at, then we can move as fast as 2 weeks. If we meet a founder that has not reached the appropriate level of progress, then it could be 3 months, 6 months, 9 months. In some cases, it's been 15 months. But if we really like the relationship with the founders and we've built a relationship there and we believe in them as founders, then we very actively engage with people on an ongoing basis to kind of monitor their progress, to help them out, give them input where it makes sense. And we'll pull the trigger when it's ready. So it's highly variable at the stage we invest. We, as pre-seed investors, we set the venture clock. As soon as we invest, then startup is typically on an 18-month raise schedule in perpetuity. You're kind of raising money every 18 months. You know, you go from pre-seed to seed plus to Series A, Series B, et cetera. But at the pre-seed stage where we invest, we kind of set that clock. So when a startup comes to us, there's not a predefined schedule. They're not necessarily at the point where they're institutionally fundable.
Very well said. Thank you for that. And then our next question is from Chris Freeman. Do you anticipate New Stack's vertical investment / funding interest changing from where you have been to where you are headed post-COVID quarantines? Are you changing your investment thesis based off of
Right.
vertical or otherwise?
Well, I'll say quick thanks to Kevin. Kevin, it'd be good to reconnect soon. But for this question, no, we're not changing our focus. Our original focus is more horizontal in nature. So having like a deep tech focus, having a focus on pre-seed, those aren't sector or industry vertical specific thesis or themes. So there really isn't a shift there. But I'll caveat that with saying that, industries that are severely adversely impacted by the virus, it's going to be really tough for us to make a commitment in those spaces right now. It's just, there's so many headwinds. It's going to take a while to come out of those. So we're probably going to be focused more on those industries that are either neutral or positive, positively affected by the virus. And quarantining and social distancing and all that comes with it.
Well said. Thanks for the question, Chris. Matthew Taylor asks, hey, Nick, thanks for the great information. What is the optimal runway guidance you are giving your pre-Series A portfolio companies? 12 plus months, 18, 24 months, et cetera.
Yeah, good question. I love to see a minimum of 18 months, a year and a half. That's, barring the situation with the virus. But I think amidst the situation we're going through, if you're north of 18 months, you're in a pretty healthy spot. If you're north of 2 years of runway, that's great. If you're in the 12-month or less range, I'm typically calling founders and trying to figure out ways that, we can extend that runway, whether it's new sources of capital or discretionary expense reductions, or things of that nature. It's especially in categories that are affected adversely by the virus. Like we have an investment in a travel-oriented startup. It's going to be a while before those guys can raise money again. Fortunately, they do have some good capital in the bank, and they've taken a lot of measures to extend. But it's going to be a while for those guys, and so they're going to need even more security there. And it also helps if the markets do reopen, if the quarantines go away, even if you have another 18 months of capital, it's helpful to be able to use that capital again then for growth and to show metric and progress growth toward a subsequent fundraise. So for a lot of reasons, regardless of how long the crisis lasts, for a lot of reasons, it's very helpful to extend that runway.
Thanks, Nick. One more from the attendees. I'll have one more question for you, then we can wrap up. Matthew Wilson asks, as an angel lead, what are your thoughts on co-syndicating deals? Do you find other leads are generally reluctant or open to the idea?
We have not co-syndicated any deals. It's a good question. It's something that comes up a lot, mostly on AngelList. I don't think we also use another platform called Assure. I've never gotten a co-syndication offer there. People do reach out to us and ask us if we'd be willing to co-syndicate. I think that what they're trying to do, I'm actually not sure what all the motivations are behind that, but my assumption is that they're trying to leverage the extent of our network because we have one of the larger, more active syndicates on AngelList, and our performance has been in the top 3. I think we're ranked number 2 right now. And so I think they're trying to leverage kind of our brand and our network to prop up kind of the participation from other angels in the syndicate. But we have not accepted any of those offers yet. We've always just syndicated our own deals. I can't confidently just jump into a deal with another person that's diligenced it. We have our own diligence process. We have our own getting to know the founder process. It's pretty involved. And I can't just make a quick decision because somebody else thinks the deal is pretty hot and it looks really good in the pitch deck. So we haven't done that to date. Good question.
Good question, Matthew. Last question. Sorry, Ken Miller had something for you. Sorry, Ken. Shout out to Ken in the West Suburban Angels group, which is where Nick and I met, by the way. My last question, if anybody hasn't seen Something Ventured, it's a documentary. I think it's on HBO. Check it out. Might be on YouTube. Check that out. It really kind of goes into uh, the birth of the venture capital industry, and they focused on the initial investments in the semiconductor industry, into computer hardware and software, so Apple, Microsoft, what have you. And from there, I think a lot of the big opportunities are a direct reflection of what's going on from a technology standpoint in the world, and the network effect of these things. So then you saw the internet age. A lot of companies were built on the internet, a lot of investment in those companies. I would maybe categorize a lot of activity over the last maybe 10 to 15 years in mobile, consumer, and business applications. Howard Tallman was interviewed recently, and he made a comment about 2020 predictions in the sense that what's going to get funded. And he made a interesting point that everything's pretty convenient at this point. Whether you're an individual, there's an app for this, there's an app for that. If you're a business, there's been a founder that's saw a challenge and created a solution around that. Maybe a prediction from Nick for 2020 to 2030 or beyond. Where do you see the next like monster big opportunities as it relates to the venture capital industry as a whole?
It's a good question. We've seen a lot of different phases of technological development. The desktop, of course, and internet explosion, and mobile, of course, has been big. But running in parallel with those things, we've also seen kind of the explosion of telecom and connectivity. We've seen the growth of cloud, doing a lot of things in the cloud instead of on-prem. And I think of the future in kind of two different ways. I think of the way consumers and individuals interact with technology, and the way technology performs independent of individuals, but helps accelerate our quality of life. So on the interaction front, desktop was one of the first ways that we interacted with the internet, right? And then mobile is kind of a huge platform for interaction and UX. As I think forward to like what will be the next platforms for interaction, I think audio is a huge platform. We're seeing that with the devices like Google Home and Amazon Echo and such. But that is another way of us interacting with the interweb, right, on a regular basis. It's another form of UX. And I think that audio itself will be a platform that a lot of apps and other things are built on top of. Another one that I really like and we've invested in is augmented reality as opposed to virtual reality. I can see a future where we have a lot of data and input at our disposal all around us in our field of view, maybe in our peripheral vision, maybe on the windshield of our car, maybe in different form factors, but not completely obscuring the physical world and the physical environment like VR does, but adding to it and augmenting the physical world with augmented reality. As far as that second category, like things that we're not aware of, that's why IoT is kind of this big trend that we've been investing around and investing in for so long. The sensors that exist all around us to kind of monitor what we're doing and enhance our life in a variety of ways are only increasing over time. Bilal Zabiri from Lux Capital was on my show, and I think he mentioned that in the 1970s, there was one camera per family. And in the 1980s, there were two cameras per family, maybe a video camera and a regular camera. And in the 90s, it was like one camera per person. In the aughts, in the 2000s, it was 2 to 3 cameras per person. So people had like a cell phone, maybe a digital camera. And now we're in the 2020s now, but in the 2010s, it was more like 5 to 7 cameras on average per person on the planet. So that just gives you a sense, a camera is only one type of sensor. It's a visual sensor, but there are temperature sensors, audio sensors, vibration sensors, pressure sensors. There are all different types of sensors that can interact with you and interact with the environment, monitor what's happening and improve a situation or detect an anomaly or a health issue, for instance. And these sensors are only going to get more ubiquitous and kind of enhance quality of living. you know, I could walk into my office today and the lights turn on and my computer turns on and it gives me a briefing on everything that's going on with the day. None of that happens. That all takes, you know, that takes an action on my part to do those things. But I see a future where we live in a much more automated environment.
That's so interesting. I think, you know, a lot of the thing that you had mentioned, and we talked about this at the beginning of the show, it's going to be really hard for a person with an idea to get, you know, a CTO co-founder to write up some code and take an application to market and then be a multi-millionaire from that. Everything that you had mentioned takes a very interesting and unique subject matter expertise in a certain area. I could see a trend based on what you're saying that, you know, the typical founder is going to have to be the PhD based founder, the science based founder, the like deep, intricate knowledge, and then maybe partner with, you know, a business focused founder, which is interesting. And we can kind of go on and on for days about that. But Nick, I've always enjoyed hanging out, having conversations like this. We grab coffee every 6 to 9 months. I'm glad we were able to do this on Zoom and then let some of these attendees into that conversation. Hopefully next time we chat, we could do that in person at a Starbucks or something. But thank you so much for carving out some time for us. If folks want to listen to the podcast, get in touch with you, where can they find you?
Yeah, the podcast is fullratchet.net. The website for the venture firm is newstack.vc, and I'm on Twitter at the Full Ratchet.
Thanks so much, Nick. Have a good rest of the day. We'll talk to you soon.
You're a great host.
All right. Take care. Appreciate it.
Take care. Thanks, everyone.